What's going on YouTube? Chris here. A couple weeks ago I made a video about my Tesla option and stock position, and in that video Tesla stock was around $485 if I remember correctly. And in that video I had mentioned that I put on a bunch of bullish trading positions, meaning that the positions that I put on would profit if Tesla shares continue to increase. And I also outlined a brief action plan for if the stock price was going to decrease as well. And as luck would have it, immediately after publishing that video, Tesla shares crashed. And as I record this today, Tesla shares are around $360 a share, meaning they've fallen over $100 since recording that other Tesla video from the other week. And understandably, I got blown up in the comments section with people saying things like, RIP to his positions, retire from options trading right now, this video didn't age well. So today we're going to look at the position as it stands today and some of the things that I have done since that video and answer the burning question, did my Tesla position blow up? Let's go ahead and hop over to the trading platform and check it out. So the first thing to note is Tesla, as I currently record this, is at $364 a share, currently down about $8 on the day. And when I made that other Tesla video, Tesla was around $490 to $500 per share. So obviously since then, the stock price has been collapsing, absolutely collapsing. So let's go ahead and take a look at the position. So I'm going to go to the positions tab and I'm going to open up Tesla. First thing I want to point out is the open P&L, meaning the profit or loss since opening this position, at least from all the positions that are currently still open, the profit is around $13,000. When I made that first Tesla video, the profit was around $25,000. So yes, the position is taking some heat right now. It has lost a lot of value recently, but let's go over some of the individual components. So I still own shares of stock, and since the other video, I actually have been purchasing more shares of stock with each subsequent approximate $50 decline in the shares. So if I go to activity and I go to Tesla, we can see that I purchased shares of stock at 428. So I purchased 5 shares at 428, purchased another 5 shares at 377, and then I purchased 10 shares at 338. And then there's a couple other positions that I put on since then. But let's go over that call spread that I discussed in that video, because I had mentioned that I had legged into a risk-free call spread, meaning that I essentially purchased a call spread, but my entry price on both options was the same. So if we look at this position, this is the 700-800 call spread in June, which has 644 days to go. So this is June 2022, I believe. So we can see that I initially purchased the 700 call for $118, and then I shorted the 800 call 2 hours later when the stock price was higher for $118. Now if we look at the open P&L of these two options, we can see that the short 800 call is up $4,600, but the long 700 call is down $3,600. So this call spread is up $1,000. And if I click close position, we can see that it says max profit, max loss, which is basically if I close this position, this is what my P&L would be. So it's right around $1,000. So far, so good. So if we look at the 500, 600 call spreads that I was already into before the stock split, we can see that the long 500 calls are up around 20,000, so 19.6. The short 600 calls are down 17.8. So this position is up, what is that, like $1,700? Let's go ahead and check. There we go, $1,725. So those call spreads are still doing good. I had mentioned that obviously with a massive run-up in Tesla's share price, that there was a possibility, of course, that the stock price could collapse. And we saw a massive tech sell-off last week, and it's still kind of continuing right now. But I had purchased 2 of the November 300 puts in Tesla, and that was when Tesla was at $480 a share. So I paid right around $1,600 for each of those puts, and I purchased 2 of them, shelling out about $3,200. Now we can see that these puts are worth $28 each, or $2,800, and therefore the profit on these puts is $2,400. So these puts are protecting some of the losses. Obviously, they have not protected the full loss because when I entered them, I did not put on a full hedge, meaning I still had positive position delta. So if we look at the Tesla delta right now, we can see it says 104. What this means is that my position is expected to make or lose about $100 for every $1 change in Tesla's share price. So obviously, if Tesla continues to slide, this position is going to continue hurting. But if Tesla continues to decline, these 300 puts are going to be more and more effective, because right now we can see the position delta for these two 300 puts is -50. Now the maximum delta of a put option, the position delta I should say, is -100, which means the most sensitive that these puts could be to a $1 change in the stock price is $100. So if Tesla continues falling, the position delta for these puts will continue to grow, and it will effectively reduce my bullish exposure, because these put options could go from a delta of -50 to a total delta of -200. So that would actually put me into negative delta territory if I changed nothing else. So I'm going to continue holding these 300 puts. I do not plan on closing them because they're doing their job right now, and the position is still positive delta, which means if Tesla is up $100 tomorrow, yes, these 300 puts will lose money, but the overall position will make a lot more money than whatever was lost in these puts. So recently I did the 375, 425 call spread, which is down about $100 right now. I've only been in this for 3 days, and this is a shorter term bullish play. And if we look at the entry prices, we can see I paid about $1,500 for this call spread, and it has 35 days to go. So one of the catalysts that's coming up for Tesla is Tesla Battery Day, and that is on September 22nd. There's a lot of speculation around what Tesla is going to announce during Battery Day. Obviously, they're going to talk about their battery technology and any substantial improvements or breakthroughs in their battery technology. That's going to be probably a very positive catalyst for Tesla shares. But there has also been some commentary from Elon Musk where he talks about he's going to announce some other things related to the company that are not necessarily specific to the batteries on Battery Day. So be sure to watch out for Battery Day on September 22nd, because it will be a catalyst for Tesla shares, either positive or negative. So this call spread is going to do extremely well if Battery Day is a positive catalyst and Tesla shares do increase from here. We can see that I have this 420, 360 short put spread in Tesla. And this was actually part of a bearish put butterfly that I purchased. So if we go to the activity tab, we can see that on September 1st, I purchased the 480, 420, 360 put butterfly spread. My reasoning for that was Tesla was right around $480 a share when I made that other video, and I wanted to put on a cheap protectionary trade, and one of the ways you can do that is by purchasing a very near-term put butterfly spread. So I essentially purchased the at-the-money put, which was the 480 put at the time, and then I shorted 2 of the 420 puts and purchased 1 of the 360 puts. And the best case scenario for that position is if Tesla continues to slide and ends somewhere close to $420 a share when those options expire. But what happened was Tesla actually collapsed way below that put spread, or put butterfly spread, and when you have a put butterfly spread, you have a put debit spread as the top portion and a put credit spread as the bottom portion. So since Tesla tanked through the entire put butterfly spread, what happened was I sold the top portion of that spread. So I closed out the put debit spread of that butterfly position, and I sold that put spread for $55. So since the put debit spread had a strike width of $60, meaning 480 minus 420 is 60, that means that the most that put spread can be worth is $60. So since it got to $55 and it could only have appreciated another $5, I decided to close the put debit spread portion of that put butterfly. Now what that does is it essentially increases the risk of the butterfly by about $500, because if I would have held this put spread and Tesla was below 420 at expiration, then this spread would have been worth $60 as opposed to $55, which means I would have made an additional $500 from it. But since I could have only made $500 from it, but I could have lost $5,500 from this portion of the trade. I decided to close it, and my hope is that Tesla rebounds from here and is hopefully above $420, or at least somewhere close to $420 when these options expire in about 7 days from now. So I'm still holding the short put credit spread. Now you might be wondering, aren't you worried about early assignment on this short 420 put because Tesla's at 370? And the answer is no. If I go to the trade tab and I go to the September 18, 2020, well, that's the wrong one. If I go to the September 2020 expiration cycle with 7 days to go, and I open this up, I can go to the 420 put, and I'm going to change this column to EXT, which shows me the extrinsic value in every single option. And we can see that this 420 put has $5.50. It's jumping around. But this put has over $500 of extrinsic value in it. And that means if somebody exercised this 420 put, they would essentially be burning $500 for no reason whatsoever. So if that person really wanted to short 100 shares of stock through exercising the 420 put, then they could just sell the 420 put and short 100 shares of stock. Be the same thing, except they wouldn't give up the extrinsic value in the option. So whenever you're worried about early assignment on a short in the money option, you need to look at the extrinsic value, and if it is substantial, which it most likely will be, if there is pretty decent amount of time until expiration, then you have no reason to worry about early assignment. And in fact, if I were assigned early on this put, it would actually be a good thing for me because this extrinsic value would go to 0, which means that would be beneficial to me because when you short an option, you don't want it to have any extrinsic value whatsoever. So if somebody makes the decision to take its extrinsic value from $600 to $0 through exercising it, that benefits anybody who was assigned. So obviously that would be a large position, and then I would close out the stock position. But being assigned on this is not worrisome for me at all. So another thing to point out, as I mentioned earlier, is I've been purchasing more and more shares of Tesla, and I also purchased these short-term puts for very cheap as an additional protectionary measure should we see significant declines in the market in the near term. So basically, to wrap everything up, the position is doing just fine. I am really not worried about it because these bullish call spread positions have about 2 years to go, and that's a really long-term trade. So these positions are still going to do very, very well if Tesla regains traction and continues to perform well over the next year, year and a half. But obviously at some point, I need the shares to appreciate to levels higher than these strike prices, or at least get closer to them so that these positions appreciate in value, giving me an opportunity to manage them or close them. But the main position is the share position, and that's really the only thing that matters because this represents actual ownership, and I never have to be nimble with this position. I don't have to adjust it or trade around it. I can just hold the shares forever. But obviously with the options, I am trading the options with smaller size around the share position to either amplify the gains in a scenario where I think the stock price is going to rise significantly, or in scenarios where I want to actually protect against some of the losses on the downside. And it's unnecessary, but this is how I'm trading the Tesla position right now. So that about covers it. I know I moved really quickly in this video, but this is not supposed to be one of my beginner how-to videos. This is supposed to be for those who are experienced with options and are trying to see the things that I'm doing in my account, at least with this Tesla position. So I'll continue to do updates on this position in the future from time to time, but I just wanted to update everybody right now because Tesla has slid over $100 per share since uploading my previous video. And yes, the position has lost profitability since then, since obviously if it's a bullish position and the stock price falls, the profitability of the position will decline. But hopefully you can understand that the call spread positions that I have are still profitable despite seeing over a $100 decrease in the shares. And as I mentioned in the previous video, the puts that I purchased are offsetting some of those losses, although not to a significant degree right now. But as I mentioned in this video, as Tesla shares continue to decline, or if Tesla shares continue to decline, the puts are going to be much more effective since the deltas of the puts will grow, meaning that with each $1 decrease in the share price, the puts for the next $1 decrease in the share price will appreciate even more than the previous $1 decrease. And that's because when you own options, you have positive gamma, which means when the stock price moves towards your option strike that you own or through it, the directional exposure of that option position starts to accelerate and grow exponentially. So I hope everybody enjoyed this video. Once again, my name is Chris from Project Option. If you enjoyed this video, please give it a like down below. And if you're new to the channel and you have no idea who I am, please consider checking out some of my other videos and subscribing to the channel if you enjoy what you see. I will see you all in the next video.